Gentlemen, great to see you both. Thanks for being with us. Paul, let me begin with you because part of Tepper's point was that, the Fed gets criticized for not seeing, quote unquote, high frequency data. His point is that they actually do. Do you think there's anything about their radar that is suspect?
I thought David's comments were very thoughtful, and I also thought they were very tactical in the sense that the Fed has made very, very clear that they want to see a weakening labor market. They're focused on services inflation, and that's labor, and they haven't seen it yet, so therefore they are hawkish, which puts David into a situation of wanting to be tactically risk-averse. And I don't think that's wrong. But fundamentally, where my perspective is coming from is the Fed's going to be successful. And I think that's why the belly of the yield curve is so inverted relative to the policy rate, is the market's betting, strategically speaking, that the Fed's going to be successful.
What do you do with that argument, David, when Tepper's saying you got to believe them? They're telling you what they're going to do.
Well, they are telling us what they're going to do, but I personally think that a strategy which says we're going to raise rates more and then, by the way, in 2024 we're going to cut them is exactly the wrong strategy to start with. That's saying that we're going to add to the amplitude of the business cycle. What we can see right now is the economy is slowing down. Index of leading economic indicators down 9 months in a row. It's telling us something. Inflation's going to fade anyway. I think we'll be down to about 3.5% on CPI by next December. There's no reason for the Federal Reserve to push us into a recession right now to get it to come down any faster.
So do you see things differently than Tepper in terms of the opportunity, even though you may necessarily agree sort of to a certain extent on what we're going to see in the early part of next year in rates?
Strategically, I think there's plenty of opportunity here. The question is timing. At some stage in the next few months, the Federal Reserve is going to realize that they've overdone this because the economy is slowing down more than they thought and inflation's coming down. I mean, even by March, I think the CPI is going to be down to about 4.5% year over year. So it's going to be coming down fast. The Fed's going to eventually pivot here. Now, how markets behave between now and then is obviously, it's difficult to predict, but I wouldn't want to wait too long in terms of getting positioned for the long run because you can sort of see this one coming.
Yeah. Paul, do you agree with that?
Yeah, David Kelly and I are pretty much in agreement. The Fed's in the right neighborhood. They're restrictive. They're going to probe a little bit deeper into restrictive. But from a strategic perspective, the starting point of restrictive says you should look at disinflation and a pivot down the road and start discounting that into long-duration assets now.
There's been some discussion this week, David, about the rotation of votes. Bullard, Mester, George are going to exit. We're going to be bringing in Goolsbee and some others who were seen to be more dovish or at least more centrist. You think that's going to be material to decisions?
I don't. I was really struck by the fact that pretty much every member of the Federal Open Market Committee increased their terminal rate in the dot plot in December relative to September. And it's almost like there's a quiet memo going out. By the way, the messages are going to be tighter. You'd better push up your forecast. And it didn't seem as independent as it should be. So I think for whatever reason, they're in lockstep in this idea that we've got to give the impression that we're going to be ultra tight, for right now, because I think they're trying to maneuver long rates up. But again, I don't think this is going to persist for very long because I think the data is just not going to be with them.